Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are joined by a returning fund manager, Will Granger. He's a portfolio manager at Airlie Funds Management. He runs their small companies fund, and we're talking all things small caps today.
Yes, the fund launched only 2 years ago, so early days and plenty of opportunity that Will is sifting through. So today we're going to start by asking Will how he's currently separating a lot of the signal from the noise, because the market is incredibly noisy at the moment. Then get a sense of how he's thinking about the fund itself. You know, what's the type of companies that he's investing in, the characteristics of the fund, and of course we'll be closing out with some stocks on his on the fund's watch list. Yeah,
I think having spoken to Airlie over the years, particularly Emma Fisher, people may be familiar, we always appreciate the kind of companies they're looking for. You know, I think it aligns with what we're looking for as retail investors, those long-term compounders that can sit in the portfolio and grow and reinvest for years to come. And so hopefully Will's got a few good names in the small cap space that we can add to the watch list.
Big time.
But before we do get into it, we do want to say a massive thank you to Airlie for sponsoring this episode, for helping us keep all of our content here at Equity Mates free. But Bryce, I think with that said, let's get to our conversation with Will Granger.
Well, Will, welcome to Equity Mates.
Thanks for having me, guys.
So it's been an incredibly noisy start to 2025 in markets, probably one of the noisiest at least we've lived through. What do you think will matter the most long term?
Yeah, I definitely agree. It has been a really sort of noisy market. Obviously had the tariffs more recently, but even before that, I think it was one of the most volatile reporting seasons that I've ever experienced. But in terms of what matters over the long term, really for us, when you think about our sort of investment philosophy, we're long-term investors, and it's really down to the business fundamentals. It's the fundamentals of the stocks that we own. Even more sort of specifically, it's really the durability of those businesses. I remember years ago reading this excerpt on durability that's always stuck with me since I read it. And it was one of Michael Burry's old MSN blog posts from the early 2000s. I don't know whether you guys have come across them.
No.
But anyway, for those who don't know, Michael Burry's, quite a famous investor. He particularly shot to fame after sort of predicting the housing bubble during the GFC. He's the guy that Christian Bale plays in The Big Short. Yeah. If you've seen that movie. But anyway, he had this thesis on Caterpillar back in the day, the provider of heavy machinery. And in that thesis, he really focused on the importance of durability in valuations. And he made this sort of really astute point that if you think about the mathematics of a discounted cash flow model, what you'll notice is that for any sort of growing business, the vast majority of its intrinsic value is going to come from cash flows generated north of 10 years into the future. And it's really interesting when you think about that. And it's really stuck with me because it shows you that it's not these short-term movements and profits that matter and impact your valuation. It's, how durable is the business? Will it be around in 10 or 20 years still producing strong cash flows? And I think that's part of, what's informed our philosophy, at Airlie and in the fund. We have a strong focus on buying quality businesses. So, businesses with really durable competitive advantages that are protected from competition. And that's because they're the sort of businesses that will persist over time. And so that's what sort of underwrites that valuation. Another sort of piece of durability in terms of, caring about the long term is even if you've got this fantastic business, if you don't have the right balance sheet, then what should be a short-term movement in profits, can be catalyzed or crystallized into a, long-term sort of destruction of returns. So you really need a balance sheet that can sort of endure any sort of short-termism or noise in markets. I think the other thing that's sort of interesting when you think about investing through the lens of durability is it really changes how you think about your circle of competence. So for those who don't know, it's the range of businesses that you think you can comfortably understand. And if your threshold for understanding a business is what does this business look like in 10 years, that vastly changes how you think about understanding. And you start to realize just how limited that sort of circle of competence is. It's why you probably won't see us invest too much in a lot of the more sort of fast-moving tech or biotech names where, there's big advances and changes in science and lots of disruption happening, because you don't really have the faintest clue what those businesses are going to look like in 10 years. I was listening to a podcast the other day with Demis Hassabis, who's the CEO of Google DeepMind, and he and his team just won the Nobel Prize in chemistry for solving protein folding. And protein folding, the rule of thumb used to be that it'd take a PhD student their whole PhD to solve a single protein fold, the structure of the protein. And now with this AI model, they've solved 200 million protein structures. So that's a pretty big step change, and potentially has massive ramifications for things like drug discovery in the future that could really upend a lot of these sort of biotechs. So I don't have the faintest clue what they're going to look like in 10 years. And it's why a lot of those names we try and avoid, and we stick to what we can really understand. I've had the good fortune of working with Matt Williams and Emma Fisher for, I think, over 5 years now. I've had to distill why I think they're great investors into one trait. It's their ability to sit within their circle of competence. They're very good at understanding, the limits of their knowledge and what they can predict, and sort of sticking to their knitting. So it's something I try and emulate myself.
Nice.
Love that. I love that focus on long-term durability, and I find it so interesting. A lot of the value comes in the out years of a DCF. How do you marry up that analysis and that, I guess, framework and thinking with some of the short-term pressures you're under as a fund manager, thinking about having to report quarterly or half-yearly results?
It is difficult because there is obviously business risk if you've got short-term numbers that look bad, but I think that's part of what presents the opportunity for us, is that if you just communicate to your investors and you say, we're taking a 3 or a 5 year journey, then you're happy to take positions in businesses that might be, about to downgrade earnings, that won't be of too much consequence to their actual intrinsic value. So I think that sort of timing arbitrage in markets is, one of the sweet spots that's left in terms of making a lot of alpha. It's a job where you are sort of inundated with noise every day. I'm always getting hundreds of emails and suggestions and stock tips and macro rumblings, and
send them our way.
Well, I'm not sure you want them. And you've got the stock market there, which is giving you prices every second on every stock, and so it's an environment that forces you or tries to force you to make decisions and take actions. And part of what's hard about the job is sitting back and being patient. Buffett's obviously famous for isolating himself in Omaha to get away from sort of the noise of Wall Street. And I think there's something to that. Part of sort of avoiding the noise is having a good, solid framework for investing. It's understanding what you're actually looking for in businesses. And if you're like us and you care about investing over the long term and you understand that short-term movements in profits don't affect valuations, well, it's easy for us to shut out the noise. I don't spend too much time focused on whether a company's going to beat or miss earnings, because at the end of the day, what matters is, has the competitive advantage changed? Things like market share, industry structure, any changes to long-term growth rate assumptions or margins. That's what really matters, not this sort of short-term stuff.
What behavioural things or processes have you actually worked into your day-to-day to, I guess, cut out a lot of that noise? Because it's not like you could just completely ignore it. You've got to keep an eye on it, but it could become pretty overwhelming.
Yeah, it's hard because there isn't, I think that's one of the skills of the job is trying to work out what is important, trying to discern between the information that matters and doesn't, seeing the wood for the trees. But we don't really have any sort of day-to-day process that solves for this. It's part of the temperament of trying to invest for long term is you just can't let it affect you. So I don't have any silver bullet to solve it. I think you've got to focus on, developing an investment philosophy that can be your anchor that indicates the things you should care and not care about.
You said there's a lot of information coming at you. What are some of the the highest value sources of information you find? And I guess particularly any that are accessible to people like Bryce and I, anything that you go to first. And I guess on the flip side, anything that you just don't read.
Yeah. I'm probably going to give you like a very boring answer, but the most, easily the highest source of valuable information is a company's historical financial statements. It's a boring answer, but it's definitely true, particularly if you're sort of coming at it from our sort of philosophy. We're, again, trying to buy businesses with sustainable competitive advantages that are protected from competition and can grow at attractive rates on incremental capital. And often the best indication of whether a business has that durable competitive advantage is what's it done in the past? Does it have a track record of generating attractive returns? Competition theory tells us that capital chases high returns. So if a business has generated strong returns over history, that could be a good indication that it has some sort of competitive advantage. Now, we then want to understand that to work out whether it can continue into the future. And the best way to do that is reading all of the historical annual reports. It's putting that track record together. Another good source of information is just looking at the competitors' financials and really getting an understanding of the industry structure. I think one of the best indications of Bunnings' competitive advantage back in the day, it wasn't its own fantastic track record, although that was important. It was the track record of Masters. They had a really well-funded competitor come into the market, really well capitalized, backed by Woolies. And after 5 years and I think close to $1 billion in cumulative losses, they exited the market. So that's a pretty good indication that you've got, a moat or a competitive advantage that's been tested. And that gives us a lot more confidence in the quality of that business. I think particularly in small caps, applying that sort of work is really important and you can get a bit of a leg up. One interesting thing you can do in small caps is, particularly at the sort of micro cap end of the scale, a lot of their competitors will be private companies, and you can actually go and buy private company financials off ASIC if they're above a certain level of turnover. So
that's interesting.
Obviously, most public companies or all public companies, you can look at their annual reports, but you can do the same thing for private companies of a certain size. And so sometimes we can piece together an industry structure that gives us this really sort of illuminating understanding of the business that perhaps some competitors might not have. So that can be really valuable. It's easy to just look at the financials, but, I think you do need a good understanding of accounting. Sometimes statutory profits, particularly in some industries with more complicated accounting, they can be quite misleading. I was fortunate enough at my old job to run a sleeve of a long short portfolio. And the best shorts that I ever found were these businesses, committing accounting shenanigans. One I remember was Freedom Foods. I don't know if you ever came across that. Yeah. It was really committing every sin in the book. And, overcapitalization of expenses, taking one-off gains on acquisitions above the line. If you looked at the statutory accounts, they didn't look that bad. So you need a good understanding of accounting to sort of derive the economic reality of the business that's sometimes a bit hidden. I think it's important for people to learn a bit about accounting as well. We have a big focus on management quality at Airlie, and one of the best signs is, does your manager have skin in the game? There's been a series of some pretty poor acquisitions, some bet the farm type acquisitions on the ASX over the last few years. And I think a through line has been these managers that just don't have any skin in the game. Often they care more about empire building than they do about actually looking after shareholders. And it's easy to see why in some cases. Obviously, there's a bit of clout that comes with running a bigger business. Your pay is probably correlated to the size of the business as well. But we have a strong focus on buying owner-managed and founder-led businesses. And if I look at our portfolio in small caps, I think 55% of the fund's invested in owner-managed businesses. So we're well aligned with our managers.
Are there any interesting ways that you're integrating AI into your process at all?
Not really as of yet. I mean, I think it's an interesting research tool as a start, but, I think so far, it's not the most reliable source. It's still prone to hallucinations and things like that. So it's something we're constantly working on and thinking about. But I think as it stands today,
human intelligence
is still winning out. But we'll see how that changes. It's one you got to watch.
Yeah.
Well, let's turn to what's happening at Airlie, because Airlie, I think, is well known in the Australian finance community for large caps. But what was the thinking around the decision to launch a small caps fund?
Yeah, so we launched the fund 2 years ago. Actually, I think it was the 2-year anniversary was last week. So just fresh past the 2-year mark. But thank you. And really pleased with how it's going. But, really, when we were thinking about it, sort of the genesis of the fund well predated that launch. And that's because, small cap investing is something we've been doing for a long time at Airlie as part of our other sort of funds and mandates. Businesses like Nick Scali, Premier Investments, PWR Holdings, Seven Group, all of those names were some of our best performers, and they all started out in small caps. So we felt like we had an existing expertise in small caps and an ability to find these really great little compounders, and the team themselves. So the sort of institutional definition of small caps typically is anything outside of the ASX 100. And so if you think about our analyst team who look up and down the market cap spectrum, they're probably spending 25 to 50% of their time looking at small caps. So we're already producing this big body of work, and really the fund's just leveraging that. And then you think about small caps as an opportunity, and it's a really exciting market. It's a very broad and deep market. It's prone to a lot of inefficiencies. It's not, particularly well covered. So you can get some really amazingly attractively priced businesses. And often they're just at the sort of start of their growth trajectory. So you can hold them for 10 or 20 years. They roll out stores or reinvest in whatever their core competency is. I think the other thing that's kind of interesting about small caps is it's a part of the market that's very well, that lends itself very well to active management. If you actually look at the performance of the Small Ords Index, it's been a shocking index over time. It's a terrible place to put your money.
Yeah.
I think if you'd bought the Small Ords Index when it was first created back in March 2000 and held it till today, you would have enjoyed just half the return of the 100 over that time period. So it's been a stinker. When we think about that, obviously that sounds unattractive, but there's another data point that I think is a good sort of counterbalance to that. If you actually go and you look at the start of every year, at June 30, if you compare the ASX 100 with the Small Ords, and you look at what were the top 10 performing stocks across both those indexes, as measured by their total return over the next 5 years, on average, 8 out of 10 of the best performing stocks are actually found in the small cap universe, which is quite interesting. And it's quite surprising given how poor the performance of the broader index has been. And I think there's a couple of sort of points you can take away from that. One, if you do want exposure to the best performing stocks in the market, they're in small caps, so you do want some exposure. Two, obviously the index performance is terrible, so you want an active manager. And then three, given it's home to the best performers and yet the index is terrible, there must be a lot of sort of junk that's weighing down that performance. And you sort of take a closer look at the constituents of the Small Ords Index, and it's pretty easy to see where it goes wrong. I think of the 180 or so constituents, I think 1 in 3 have generated negative free cash flow over the last 3 years. 2 out of 3 generate a return on equity less than 12%. I think of 12% as being really the bog average business, and 2/3 of the index is below that. So really it's, there's a lot of junk that's in that index, and you want an active manager who can sort of apply a robust process that sifts through those weeds and finds the attractive opportunities.
So one limitation we often hear when it comes to small cap funds is they have to sell their winners. And I think you guys have factored that in. One of the rules around your fund is the companies must, when they're first acquired, do not rank in the ASX 100. Was that the thinking, or are we just trying to read into something that's not there?
It is. It's a very good pickup. Yeah, you're right in that it is a bit of an issue for a lot of small cap managers where you find this great stock and then it crosses this arbitrary threshold where you then have to sell it and leave some money on the table. And so we wanted to structure the fund where we could maximize the value of those winners. So the way it works is we can't buy a business that's already in the ASX 100. But if we own a business that's a small cap and it graduates into the 100, we're allowed to keep trading in that. Now, the caveat is we can't have more than 20% of the fund in ASX 100 names. Yeah. So theoretically, if you got to that point, and we're not close to it yet, but if you got to that point, you'd have to start selling those names. And we felt that really struck the right balance between maximizing winners, but also you want to stay true to your sort of small cap mandate. Yeah, it's part of the other reason why the index hasn't been a great index, right? Because it's forced to sell its winners and then it has to add losers from the index above it. It's like the Peter Lynch thing of selling your winners and adding to your losers is like watering the weeds and trimming the flowers. The index, its mechanism is basically designed to do that. We really wanted to avoid that.
Yeah. Well, the launch of the fund was almost near perfect timing. After sort of a decade of underperformance, many saw a rotation from large to sort of small last year. Has that narrative changed at all?
Yeah, that was certainly the narrative at the time. And it's funny, there are always a lot of these sort of narratives in markets about, where rotation is going to happen. Is small caps undervalued or overvalued? It's funny, I looked last night and small caps, despite that narrative, has still managed to underperform over the 2 years since we launched the fund. So trust yield small cap index. But we don't pay too much attention to that kind of stuff. Like, it wasn't really why we launched the fund. And, the nature of what we're doing, it's a pretty concentrated portfolio. We're really going to live and breathe by, the quality of the businesses that we pick and the economics of those businesses. And so we try and not spend too much time thinking about that sort of stuff.
So this will be the softest question you get in the in this interview. But we've covered off a number of reasons why small caps. But just give us the sales pitch. Give us the pitch. Why now? Why small caps?
I think the argument for small caps is really always the same. It's that you've got this very deep and broad universe. So I think there's over 700 securities that I could own in my fund. It's a deep universe, and in that universe, I'm just trying to construct a portfolio of 25 stocks, and really it's quite concentrated at the top 15. They're, I think, 80% of the fund as it stands today. So you're trying to find 15 good ideas within that universe of 700, which I think you can do, no matter what the prevailing market valuations are, whether it's cheap or expensive. So I'm often asked, when's the right time to invest in small caps? And there's always going to be opportunity there given the size of the universe.
Well, we want to dig into your portfolio in a bit more detail, Will. So I guess we start at the top. When you look at your portfolio today, are there any characteristics that really stand out to you? Is there a tilt towards industry? Is it based around valuation? Is it sentiment driven? How would you define the characteristics?
I'd say if you're thinking about some of the characteristics of the fund, and particularly how they compare to peers, the concentration is one that is definitely worth calling out. It's a very concentrated fund relative to a lot of peers, and that's because we're big believers in concentration. We think it is really rare to find great ideas. The market most of the time is pretty efficient. So if you find something that looks really attractive, then you need to own a meaningful position in it. So again, the top 15 ideas are 80% of the fund. So I call out that concentration.
What's a meaningful position?
10% is the cap we can have at cost, but we're allowed to let it run to 15%.
Right.
So something like 10% is a very meaningful position, but even 7% or 5% I think is a pretty decent slog. A lot of fundies will have 30 to 40 stocks and maybe average position size will be 3%, whereas we're probably closer to 5 or 6%. I do get asked, if concentration's so good, then why not just own 5 stocks or 10 stocks? But, anything can happen to a business. Anything can completely blindside you and destroy your thesis. So a little bit of diversification is necessary. And I think 15s to 25 is really the right sort of balance. I remember there's this great story of Joel Greenblatt when he's first going out. I'm not sure whether you guys will have heard this story, but he's first going out on his own, and he's a famous fund manager, but he's just started his business, and he's also known for his concentration. And the first big position he takes is a business called Cypress, I think it's Cypress, Florida, or Florida Cypress Gardens. Anyway, it was an amusement park that he used to visit when he was a kid. And the thesis for the investment was that business was being taken over, and there was a big spread on the deal. So if the deal went through, he'd make a lot of money, and if it didn't, he'd lose money. Anyway, about 2 weeks before the deal's about to close, he's obviously done all of his work, and he's pretty confident it's going to go through. A sinkhole opens up in the park and swallows the main pavilion, shutting down the park. And if you think about it, that's not going to be on your list of deal breakers when you're doing your work. So I think it's a funny lesson of anything can happen to these stocks. Wow. And so you've always got to be a little bit careful being too concentrated. And I think for some of the retail people, out there listening to the podcast, you do want a little bit of diversification. You never know what's going to happen. Yeah. So I'd call that out. I'd call our sector weightings. We're very sector agnostic, so we don't really look like the market in terms of how they allocate or their sort of sector weightings. A good example would be we don't own really anything in the material space or in the biotech space. And that's just because it doesn't really fit with our sort of philosophy. As we were discussing earlier, we want to buy things we can understand and predict, and those companies naturally don't fall within that realm. I've already talked about the issues with biotech, but in resources, particularly in small caps, often they're sitting at parts of the commodity curve, that are higher cost and are reliant on commodity prices to make good returns through the cycle, and often they won't make good returns. So I think part of your pitch for some of those businesses has to be, what's the commodity price going to do? And if I don't think I can predict that, I don't want to own it. Rule number one is don't lose money. And there's not much downside protection if commodity prices go the other way. I'd also say if you look at the fund today, I'm finding a lot of value in sort of the microcap area of the market. It's a part of the market that in particular is, really not that well covered and not that well looked at. And it's actually one of the great advantages of being sort of a startup fund manager is I don't have a lot of capital. So my opportunity set is a lot wider than most of my competitors.
Yeah.
And, the more capital you have, it's the enemy of returns, right? Because
so do not invest in this fund.
What have I done?
How small would you go with microcaps?
So we have a limit of 50 million as the smallest company we can own. And I do own one stock that's around 60 million, but it's a very small position. I own a bigger position in a retailer that's got a market cap of 130. It's a little business called Joyce Corporation. And, it's a classic example of the kind of thing, we look for in a business. It ticks all the boxes, fantastic balance sheet, market leading position. It's a kitchen renovation business and they're the market leader in that part of the market. They own the Kitchen Connection brand, if you've ever heard of that. And it's got a fantastic owner manager who still owns 25% of the business. There's a really long-term store rollout strategy. Like it really ticks all of the boxes. And, it's one of the lucky things about being an up and coming fund manager is you've got the ability to invest in that business when some competitors with a bit more capital, they'll be sort of sized out of those positions. So it's the double-edged sword of backing young managers. They don't have the track record to back or not as much of a track record, but on the flip side, their job's probably a little bit easier.
So we want to then dig into a couple of names. I think you've given us a few so far, but we asked you for two that we could get into a bit more detail. One that I think a lot of people will be familiar with, Nick Scali, and then one that I hadn't heard of before, GenTrack. So let's start with the one that's new to me at least. GenTrack, what does the company do?
So GenTrack is a provider of enterprise software to the utilities and airport space. Really, the lion's share of value in the business is the utilities side. So I'll just talk about that to make it a bit simpler. But basically, it's the software that runs the utility. It does everything from customer information and billing to data and energy management. They're a global business. They're operating across 7 countries and 17 regulated energy markets. So that's what the business does. In terms of why we sort of like the business and what attracts us to it, the nature of the software itself, we really like businesses that sell this type of enterprise software, this mission critical software, because typically it comes with really low customer churn, given how costly and disruptive it can be to switch providers. So for these utilities, it's a massive project. It can cost anywhere from $50 to $250 million to upgrade this software. It can take 12 to 36 months to implement. It's a massive project and it's the kind of thing they only want to do once every 10 years.
Yeah.
And that's great for the software providers because it means once you win a customer, they're basically locked in for a decade. So it creates this very durable business. There's a lot of barriers to entry there. If we wanted to start one of these businesses tomorrow, who's going to trust us with that sort of project? So it's the kind of business we like. I think GenTrack itself is a testament to that durability. The company's been around for more than 35 years, which is pretty unique for a small tech business. That's what we like about it. I think the opportunity for the business is, if you think about the competitive landscape in utilities enterprise software, really competitors fall into 2 buckets. You have the legacy incumbent players, so SAP and Oracle. They have around 75% market share. And then you have the specialist providers, so businesses like Kraken and Kaluza and GenTrack with around 25% market share. And the opportunity for those businesses is that the way we produce and consume energy is changing with the energy transition. So, the grid of yesterday used to be a pretty simple grid. It was one of centralized generation. You'd have a coal or a hydro asset that would pump energy through to businesses and consumers. So one-way distribution as well. But you think about the grids of tomorrow, they're vastly increased in complexity. You've got decentralized generation. So, I can have a solar panel or a battery in my home, and you've got 2-way distribution. I can sell and buy off the grid. There's dynamic pricing, there's smart meters. It's a vast increase in the complexity of the grid, and that means that the software that a lot of these utilities are running on, some of which is 25, 30 years old, it's no longer fit for purpose and it needs to be upgraded. So there's a huge opportunity for these up and coming players to try and take some market share in that market. And we think they've got a good chance of doing it.
Do you have a view on how big they can get?
I mean, not necessarily. Part of what attracts us to this as well is, and I think what maybe some people in the market have overlooked is, not all energy markets have moved together. There's some markets that are, further ahead in terms of decentralizing their grids than others. And the markets that have really moved first are GenTrack's core markets. It's Australia, New Zealand and the UK. And what's interesting is that if you look at the market share in those markets, SAP and Oracle, the incumbents, they've fallen to less than 10% market share. Wow. So there's been a massive change in market share there. Given those specialist providers globally probably have around 25%, there's huge upside of where GenTrack could potentially get to. And it's a big market. I think they estimate it might be worth something like $17 billion in 5 or 10 years. And so, even just a 10% share of that would be a step change for GenTrack and a massive win for the business. But who knows? There could be upside beyond that.
Nice. And just on the downside, what are you watching as a fund manager that could, indicate the thesis is slipping?
The big sort of risk with these businesses is, there's a lot of risk in terms of implementation. These are very difficult projects. And, if you've seen, it's a classic thing in markets where a company talks about how they're upgrading their enterprise software and there's always this cost blowout and delay in when it's done. And if that happens and it happens badly, it can really damage your reputation as one of the software providers. So I think one of the big risks would be that, they botch one of these implementations and that hurts their reputation, and then that makes it very hard to make new sales. I think how I get a little bit of comfort around that is just by looking at the management team. So GenTrack's run by Gary Miles, who joined the business back in 2020. Obviously that's a pretty short tenure, but he's really got a great track record in enterprise software. So prior to joining GenTrack, he separately founded and then subsequently sold 2 enterprise software businesses, the latter of which he sold to a business called Amdocs. And they're a listed business on the NASDAQ, $10 billion market cap, and they're one of the leaders in telco enterprise software. I think they've got around 25% market share. And so Gary held some senior executive roles there before joining GenTrack. So he's got a lot of experience. Perhaps even more importantly than that, he's also brought across members of that team. So GenTrack's COO used to run all of delivery for Amdocs, and he's now running delivery for GenTrack. So that's a very impressive poach. The CTO of GenTrack used to be the CTO of Xero for several years. So I think he's assembled a really impressive team beneath him, and they're guys who are experienced in running these sort of high-end implementations. So it gives you a lot of comfort. You can never know for sure, but they're the kind of guys I back.
Well, that brings us to the second stock, which I think many of us have heard of before, which is Nick Scali. But for those who haven't, just give us a bit of a brief update on what the company actually does.
Sure. So Nick Scali are a furniture retailer, in particular upholstery. They've got stores all around Australia, mostly in homemaker centres, although a little bit outside that as well. They also acquired Plush Furniture in 2021, if you've seen that brand. And more recently, they've launched in the UK. They acquired a business called Fab Furniture, which they're going to convert across to Nick Scali branding as well. So it's now a global furniture business, and it's family-led. It's run by Anthony Scali, who owns 8% of the business.
I think a lot of people probably know Nick Scali for its ads or for, they just know it as a furniture retailer. Less people know it as a stock, but it is up 300% in the past 5 years. So there are some investors that are pretty happy with the old, how many Australians are buying new couches, I guess.
They were one of the first to jump on the AI fad, weren't they? They remember?
No, that was Temple & Webster.
Oh, that was Temple & Webster. Yeah. We're an AI company. Yeah, it's Temple & Webster.
So what's the thesis for Nick Scali? Just more couches?
Yeah, exactly. It's a pretty simple thesis because, as you've sort of suggested, Nick Scali's got really a fantastic track record. It's got one of the best track records of any business listed on the ASX. It's one of, I think, just 11 companies that have generated a return on invested capital north of 15% after tax in every year for the past decade. So quantitatively, it's one of the best businesses on the market. It's got a fantastic earnings track record. I think it's grown at something like a 14% CAGR over the last 10 years. And in retail, probably more than any other sector, really the importance of good management is paramount. and you've got Anthony Scali there, who's got a phenomenal track record, still owns 8% of the business. I think if you'd invested in Nick Scali when it first listed, I want to say 2004 maybe, and reinvested all of your dividends, you would have made, I think it's 30 times your money, which is 10 times the return of the small odds over that same period. So, it's been a phenomenal stock. You're backing a great manager there to keep delivering the returns, and you've got some optionality with this UK acquisition, which we don't think is actually reflected in the price.
So that might lead to a conversation around the risk and the downside, because hearing about an Australian company going to the UK, I think triggers PTSD in some Australian investors. I think there's a lot of companies that have tried, less that have been successful. Before we talk about risks generally, how do you think about that risk of going overseas?
I think when I first read just the headline of the announcement, I groaned because it's right. It brings back these terrible memories of bad overseas expansions. Some of the classics being Boral's entry into the US with Headwaters.
Yeah.
It was a shocker.
Bunnings
home base.
Yeah.
More recently, Aurora, James Hardy as well, I guess. So it brings back these terrible memories. But I think importantly, there's a few sort of key differences with this acquisition that make it, very different. Most importantly, it's not a bet the farm type acquisition. So the total cost of the venture, including rebranding and refurbishing the 21 store network, is estimated just $50 million, which is, I think it's 5% of Nick Scali's market cap at the time of acquisition. So it's a bet with very limited downside. And, you compare that to Boral. Boral was that acquisition of Headwaters was, I think, a 58% dilution.
Wow.
Aurora's was 45% for Saverglass. So very sort of different levels of downside if you get it wrong. I also think you look at the Nick Scali management team, and we've already got evidence that they can create value through acquisition. So they acquired Plush Furniture back in 2021, as I mentioned. They acquired that business on just 4 times EBITDA. They then vastly improved the quality of the business by leveraging the Nick Scali supply chain to improve gross margins. They improved gross margins in that business by 8 whole percentage points, which is a massive increase for a retailer, which is, typically margins are maybe 10% or something. So that's an 80% increase if that's where margins were. So it's a massive step change in the quality of that business. And really the sort of formula there was the same as what they're doing with this Fab Furniture acquisition. It's all about leveraging that Nick Scali supply chain to improve gross margins. And so, management have done it before. I think they can do it again. The balance sheet's also in great shape. They've got something like 40 million of net cash maybe, and lots of property on book as well. So it's a fortress balance sheet, so plenty of capital to fund an expansion. And then, so that takes care of a lot of the downside, I'd say. And then if you think about the upside, the UK furniture market's twice the size of the Australian furniture market. So there is scope to build a business that one day dwarfs the size of the core Australian business. So it's really an asymmetric type bet, which is what we love to see in managers. And, it's the kind of bet that someone as a shareholder, Nick Scali's a shareholder, Anthony Scali's a shareholder. So it's the kind of bet he'd make, looking after his own capital.
Well, we have seen recently a couple of companies on the ASX that have been sort of founder-led come into a bit of trouble, mainly through sort of personal reasons of the founder. But how do you think about that risk with Nick Scali and I guess having so much of the thesis around the fact that he is the driving force?
Yeah, I'd say that probably is the key risk to the thesis. I'm not sure around the behavioural stuff, but that can happen with founders. There's probably a lot of ego that comes with building something like that, and a bit of hubris. I don't see signs of that with Anthony, but I guess that is the key risk. Is retail is so much about your manager, and if he leaves, then it sort of changes the conversation a little bit. But what I'd say is he still owns 8% of the business. So, when he does decide to step down, I think he'll handle that well to look after shareholders, given that he is a shareholder. And 2, going and acquiring something like this, going and venturing into the UK is probably not the kind of thing you're going to do if you're going to step down in 1 or 2 years. So I think he's probably pushed the boat out a little bit there, which is great for us. I'd love him to run it for 20 years, but it's definitely a risk with retail.
When do you start eyeing up the next generation of Scalis and start assessing their ability as managers?
Well, there is another Scali in the business. I haven't met her, but I think Matt and Emma might have met her. So perhaps that'll be the succession plan. I don't know.
Nice.
Yeah, right. Love it. Well, I think that's two interesting companies. One that I think a lot of people have heard of, but maybe not thought of as an investment, and another that is newer to people. So we really appreciate that, Will. Thanks for coming in and sharing it with us. And good luck as the fund gets into its third year.
Thanks, guys. Thanks for having me.
Thanks, Will.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.